Okay, let's take a look at the practice exam. The practice exam is going to consist of 20 multiple choice questions, which are worth 4 points each. And then you'll have 2 problems, which will be worth 10 points each, for a total of 110 points. The practice questions that I have here are a little bit on the easy side. I would expect them to be a little bit more difficult on the exam, probably similar to what you see in the CPA CMA questions at the end of each chapter. But let's go ahead and look through these fairly quickly. First question, companies that are listed on the stock exchange are required to submit their financial statements to, in this case, it's the SEC. The SEC regulates the stock exchange, so they are going to be the ones that capture all of their financial statements. They store them in a service called Edgar, which keeps track of all of the filings of 10Ks and 10Qs and so forth. Again, probably a little bit easier than I would ask normally. Question number 2, the most significant current source of generally accepted accounting principles. So this is, where does GAAP come from? GAAP is provided by FASB, answer C. Okay, the AICPA provides certifications for accountants. The APB is a former version of the FASB, and the SEC, as we talked about before, is a regulatory body. So these guys are regulators or enforcers of the rules rather than generators and producers of the rules. Next, we look at users of the financial statements. Users of the financial statements are everybody involved, talking about investors, suppliers, customers, anywhere along the supply chain. People need the financial reports to make decisions, whether they're going to partner, whether they're going to lend the money, etc. So investors and creditors are definitely the first ones that we think of. Those are definitely users of financial reports. Government agencies use financial reports in order to calculate taxes and to regulate, make sure that they're in compliance with laws. Labor unions also are going to use financial reports to see how well employees are being treated, how well they are meeting their obligations, and so forth. So the answer here is going to be all of these users, answer D. So users is a very broad perspective, but people who generally care about the financial reports so that they can make decisions. Let's look at question 4 and 5. Which of the following is not, always focus on these nots, circle them if you need to, a provision of Sarbanes-Oxley? We have, so think about what is a provision of Sarbanes-Oxley. Sarbanes-Oxley is the regulation of 2002 that requires better control of internal controls, management disclosure, better oversight of accounting practices. So of these options here, does Sarbanes-Oxley establish an oversight board for accounting practices? If you remember from Sarbanes-Oxley, they have this thing called the PCAOB, the Public Companies Accounting Oversight Board, which is a very, very key issue of Sarbanes-Oxley. Sarbanes-Oxley also was developed as a result of the financial fraud. Because a lot of the auditing firms were very close with their companies, they wanted to prevent this collusion, and so it does, in fact, provide stronger independence. Now, we have does the Sarbanes-Oxley require publicly traded companies to submit their annual reports to the SEC within 90 days of filing? This particular item is actually related to the SEC Act of 1934. So the Securities and Exchange Commission was developed so that they could collect these financial reports of publicly traded companies. So they have been collecting these within 90 days for a very long time, much earlier than 2002. This one is the obviously incorrect one. So answer D, requires CEOs and CFOs to personally certify the accuracy of financial statements, is definitely true. So the correct answer here is going to be C. C is not one of the provisions of Sarbanes-Oxley. Number 5, financial accounting standards in the United States. Okay, This one, the key thing about financial accounting standard setting, as we've talked about before, is that this is a very political process. Okay, think about legislators and politicians and people with interests trying to persuade people to adopt accounting standards that help them. So a lot of money is poured into it and so forth. So, which of these answers fits most closely to this political process? Okay, it can be described as a social process which reflects political actions of various interested user groups, as well as a product of research and logic. Is based solely on research and empirical findings. We know that's not true. Is legalistic process based on rules promulgated by governmental agencies? Yeah, that's not the best answer. Is democratic in the sense that the majority of accountants must agree for the standard to become enforceable? No. No, we don't put these standards up to a vote. The standards board, the FASB, sets the standards, and they have to deal with all of the pressures from the outside. So the correct answer is A. Number 6, which of the following, again, not correct? Focus on these words where you have not, except, and so forth. Which of the following is not correct? The PCAOB is created by the Sarbanes-Oxley to oversee the auditors of a company. That sounds correct. The FASB is a federal agency which establishes generally accepted accounting principles. FASB forms GAAP. That sounds correct. As a result of Sarbanes-Oxley, auditing firms had to spin off consulting units. This typically happened as a result of that independence issue that we talked about before in the last problem. So the AIC provides guidance on issues not addressed by the FASB. This one is not going to be correct. The AICPA provides guidance on issues that have been addressed by the FASB and help their members, certified accountants, to follow through with those. Okay. Before we move on, just a word about these. These questions tend to be from Chapter 1. So in a summary of Chapter 1, things that you'll want to focus on as you're studying. You want to focus more on the conceptual framework. Conceptual framework talks about, the objective financial reports, qualitative characteristics, different things that are happening within the organization, typically with these main 2 items of relevance and faithful representation. Okay. You'll want to understand the political process, the difference between FASB and the AICPA, as well as the SEC, and even just a little bit on IASB, which focuses on the international standards, IFRS, International Financial Reporting Standards. Okay, let's look at the next set of questions. Now we're going to get into some complicated computational ones. You're likely to see a few more of these on the exam. So Murphy Company sublet a portion of the warehouse for 5 years at an annual rental of blah, 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 blah. When you're looking at these types of questions, the first thing you should focus on is what the question is asking. So we know that there is going to be an adjustment. So the only thing we care about is an adjustment that's going to be happening. So Murphy sublet a portion of its warehouse on an annual rental. The tenant paid 1 year's rent in advance, which Murphy recorded to a credit to unearned rental revenue. Unearned rental revenue. Murphy reports on a calendar basis. Okay, so we know that the original entry that they put in had a credit to unearned revenue for $24,000. Okay, and we know that the tenant paid 1 year's rent in advance, so the debit is going to be to cash for $24,000. So this is the original entry. So the question is, what is the adjustment going to be on December 31st? The adjustment is going to record the revenue that we have earned since the beginning of the payment. This is going to record the revenue that we've earned since the payment. So on December 31st, this one was back on May 1st. On December 31st, so we're going to record rent revenue with a credit, and we're going to debit unearned revenue to reduce that account. So we're shifting it from unearned revenue into our rent revenue account. Now we have to figure out what portion it is. From May 1st to December 31st, you have May, June, July, August, September, October, November, December. So 1, 2, 3, 4, 5, 6, 7, 8. 8 months. So this 24,000, we're going to multiply it by 8/12. And that is going to give us 16,000. So $16,000 worth of the rent has been earned between May 1st and December 31st. Okay, so we look at 24,000, that's 2,000 per month, times 8 months equals $16,000. So now that we've calculated this, we'll look for the correct answer here. So we know that it's not going to be 8,000, not 8,000, it's going to be 16,000. So now, is this the correct one? Debit to unearned rent revenue, we had that there, and a credit to rent revenue, which we have there. D is the correct answer. And you just scratch out all the rest of these. You can ignore them. Okay, number 8. Which of the following would not be used typically as an adjusting entry? Okay, so an adjusting entry, remember we have two types, either to record accruals, so adjusting entries, AJEs, adjusting journal entries, these are typically going to be used for accruals. So accruals, remember, are like prepaid accounts or expenses and liabilities. That we have incurred from using these. It could also include our revenue accounts. Revenues, which would also be a liability if we have an unearned ability, if we have an unearned revenue. Okay, so rent expense and prepaid rent. Prepaid rent would be an asset. So this will decrease the asset and it will increase the expense. Okay, that looks legitimate. I think that would be a correct entry. Cash and unearned revenue. Cash and unearned revenue. This one is probably going to be an original entry. This represents somebody paying us cash for a job that we're going to do in the future. Since this is an original, it is not going to be an adjusting entry. So far I'm leaning towards this one. Interest expense and payable. Okay, so we have a payable, a new liability that's increasing, an expense that's increasing. Okay, so this looks legitimate. Bad debt expense and allowance for doubtful accounts. So our expense increases and our contra asset account is going to increase. That looks legitimate as well. So sure enough, answer B is going to be the correct answer. The primary focus for financial accounting information is to provide information that is useful for investing decisions and credit decisions. You can actually find an explanation for this on page 21 in your textbook, but the objective general purpose of financial reporting is to provide financial information about companies that is useful to capital providers in making decisions. For example, investors decide whether they are going to buy, sell, or hold equity and debt securities. And creditors are going to decide whether to provide or settle loans. So it is useful for both of these, and the correct answer is going to be A. Okay, moving right along, let's look at number 10 and 11. Jim Yount, MD, blah, 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 blah. What we care about on the accrual basis, how much is patient service revenue for 2012. So he keeps his accounting records on cash basis. Since we're dealing with revenue and we're going from cash basis, the key thing here is to focus on our accounts receivable, right? Because you have your beginning accounts receivable plus credit sales minus cash receipts to get our ending balance. So we'll set it up like this. During 2012, Dr. Yount collected $360,000. Okay, so cash receipts, $360,000 we received from his patients. At the beginning of the year, 12/31/2011, Dr. Yount had an accounts receivable balance of $50,000. So our beginning balance here is $50,000. At the end of the year, the accounts receivable balance was $70,000. So what we want to find is this value right here, the total amount of credit sales. Okay, so if you take beginning plus sales minus receipts equals ending, we're trying to find credit sales, so we can rephrase this as sales equal ending plus receipts minus beginning. So we're just rearranging that equation here. So if we plug in some values here, 70 plus 360 minus 50 equals our sales, which in this case should be 380. Did I do my math right? 70 minus 50, yep, 380. So the credit sales are going to be 380. Which one of these matches our answer? Answer C. The purpose of closing entries is to transfer closing entries. Okay, so adjusting entries are for your accruals, and closing entries are for your temporary accounts, which these include revenues, expenses, income summary, and dividends. All right, so closing, we focus on these temporary accounts. Purpose of closing entries is to transfer accounts receivable to retained earnings when account is fully paid. No. Balances in temporary accounts to a permanent account. Hey, that sounds right. Inventory to cost of sales. Nope. That just is going to be a regular transaction. Assets and liabilities when operations are discontinued. Nope. That's just normal operations as well. So the correct answer is B. Closing entries move our temporary accounts to our permanent accounts. Okay, Popson Incorporated incurred a material loss which was not unusual in character, but clearly an infrequent occurrence. The loss should be reported. Okay, we want to see how we are reporting this loss. Remember, if we want an extraordinary item, it has to be unusual and infrequent. So clearly infrequent. So we have infrequent, yes. Not unusual, so no, which means that we cannot record it as an extraordinary loss. So answer A is gone. So now the question is it a separate line between income from continuing operations and income from discontinuing operations, a separate line within income from continuing operations, or a separate line in the retained earnings statement? Well, this is going to fill into our operating income, so we know that it's definitely not the retained earnings. We're not making an adjustment here. So, is it going to be between income from continuing operations and income from discontinuing operations, meaning other, which typically includes interest, tax, and investments? Or is it going to be a separate line within continuing operations, which these are typically our operating gains and losses? Okay, incurred a material loss, not unusual, clearly infrequent. Correct answer is going to be C, because it's not an interest, tax, or investment item here. Sandstrom Corporation had an extraordinary blah, blah, blah. What is the amount that Sandstrom should report for each of these items? Okay, so an extraordinary loss of $50,000, an unusual gain of $35,000, and a tax rate, remember we have to care about taxes again, of $40,000. Since we know that these separately reported items have to be recorded net of tax, which means that they can't be recorded at their raw value. So it's not going to be 50, not going to be 35. So we know that answer A is out and answer B is out, because that extraordinary loss can't be recorded at 50. In fact, we also know that C is out because our unusual gain cannot be recorded at 35. We have to record the tax impact of that as well. Okay, Sandstorm Corporation has an extraordinary loss and an unusual gain of these amounts with a tax rate of 40%. Okay, taxes tend to be important with separately reported items. What amount should we report each of these items? Let's focus on the extraordinary loss. Okay, extraordinary loss, remember, has to be unusual and infrequent, and we know that it is both because it says that it's an extraordinary loss. So these extraordinary items have to be reported net of tax. So we can't record it at the raw value. We know that it has to be at the taxed rate. So we can eliminate answer A and answer B right here. So the question is our unusual gain of $35,000, is that separately reported, or is it part of our operations? Okay. It is unusual, but it doesn't say that it is infrequent, so we can assume that this is going to be included in our operations here, which means that we are not going to record it net of tax. We will record it at the face value, and we'll take the tax out with the rest of the revenues and expenses that we record. So the correct answer is going to be C, with an unusual gain of $35,000. That one you have to pay attention to. Remember, unusual and infrequent, you have to have both of those items. Number 14, the basis for classifying assets as current or non-current is conversion to cash within. Okay, so how quickly does it take us to convert that asset to cash? We have the accounting cycle and the 1 year, the operating cycle, or 1 year, the accounting cycle, 1 year, operating cycle, 1 year. All right. The key issue here is the accounting versus operating cycle versus the operating cycle. Now remember, the accounting cycle is going to be the reporting cycle. So we talk about journal entries to the general ledger, to trial balances, to adjusting entries, to financial reports, etc. So the accounting cycle is dealing with the recording. That doesn't really tell us about our business. The operating cycle is the point where we purchase goods or we build them into something else. We have a nice finished good that we sell to our customers, and we get cash in exchange. So this question is asking us about the operating cycle, not the accounting cycle. You can ignore that. So cross off A and cross off C. So now we're between the operating cycle and 1 year, whichever is longer or whichever is shorter. Okay, an operating cycle could take a few weeks or it could take a few years. With this one, think about a winery. Okay, they have a 2-year operating cycle on average. Sometimes they're longer, to get from the grapes all the way to getting it turned into cash. So typically speaking, we're going to go with the operating cycle, which is longer than 1 year. Even if we have a short operating cycle, like building iPods, okay, the iPod only takes a couple weeks from one to the other. We're not going to report every couple weeks. And we're not going to classify assets based on the weeks of the assets. So this one, it makes a lot more sense to cross out D and focus on B as the correct answer. Number 15, generally accepted method of valuation. Okay, valuation. So now we're looking at how we value things. Not when we originally record them, but when we make adjustments through time. So typically speaking, trading securities are recorded at market value. So if we buy investments in other companies, we're going to make adjustments each year, and this will affect our other comprehensive income. Accounts receivable at the estimated collectible rate, okay, that is actually true because we have our accounts receivable and we have our allowance for doubtful accounts, which we estimate to be, a portion of those particular accounts. Inventories at current cost is not correct. Typically, inventory is going to be recorded at historic cost. So, we know that the correct answer here is going to be D. Answers 1 and 2. Now we have a long problem. This one's going to cover questions 16 and 17. 16 and 17, we're dealing with net operating cash flow and net income following the accrual model. Okay, so we can just ignore the answers for a moment. So net operating cash flow for year 1 and year 2. And we're going to have net income for year 1 and year 2. So let's look at operating cash flow. Okay, cash flow, if you're focusing on cash flow, what you want to focus on is cash collection. So cash collected from customers. Oops. So we have cash collected. So here we're focusing on cash collected from customers and cash disbursements. So in year 1, we had $6,400 plus. We had salaries paid, $3,600 minus. We had utilities, $1,200 minus, and $2,400 in our insurance policy minus. Okay, so we take our 64 and subtract these values. Again, we don't see incurred expense we don't care about, or liabilities or bad debts, etc. So in this particular case, all of our expenses add up to $672. 3, 4, 5, 6. Okay, so this equals 7,200. So 6,400 minus 7,200 is going to give us a negative value of $800. So negative cash flow is $800. In year 2, we have 7,600 in cash received minus 4,000 minus 1,600 minus 0. So our total expenses here are 5,600. So 76 minus 56 is going to be $2,000 here. Okay, now let's look at net income. Net income is actually looking at revenues and expenses. So the amount billed to customer for service, this right here is our revenue. So we start with 68 in year 1, 88 in year 2. Now we have to look at expenses. We learned that we incurred utilities expense of $1,400 in year 1, and there were no liabilities in year 2. So there's no other information, so we can assume that salaries paid were for the total amount. So the expenses won't change in salaries. So minus 3,600 minus 4,000. Our utilities are what we care about. So of this 1,400, we actually had, of this 1,200 that we paid in cash, we actually had 1,400 that were billed. So our expenses are going to be 1,400 in year 1, and that difference of 200 is added here, so we actually have 1,400 again in year 2. Finally, the insurance policy, we paid $2,400 cash, and this covers a 3-year period. So if we take 2,400 and divide it by 3, that gives us $800 per year, which means that our expense from year 1 is going to be $800, our expense in year 2 is also $800. And now we're going to calculate this. So our expenses here were 5,800. 6,800 minus 5,800 is 1,000. in net income. And in year 2, we had expenses of 6,200. So 8,800 minus 6,200 is going to give us 2,600. All right, now we have our values, and we can look at the answers at the bottom. So net operating cash flows in 16, we had 800 and 2,000. Correct answer here, negative 8,000. Or negative 800 here, negative 800 here. There is the positive 2,000. Correct answer is D. And you can eliminate the rest of these. For our net income, we have net income of 1,000 and 2,600. There's an error on my practice exam. That should be 1,000 and 2,600. Correct answer is C here. Okay, so it's not 34, but it's going to be 26. Oops. Correct answer is C. Okay, now we're going to look on adjustments that are made. So question 18, after making a retrospective adjustment for financial statements, calculate net income. Net income is what we're looking at. Again, ignore all of this right now. Okay, just scratch it out. Focus on what the question is asking. So we have to make a retrospective adjustment because we changed our inventory valuation from FIFO to LIFO, which means we have to go back and we have to look at what it would have been if we had used LIFO for the past 3 years, because there's a change in accounting principle. The below table shows the ending cost of sales, ending balance of adjustments, net income, etc., etc. Okay. So, before the adjustments, we had 78,000. Cost of goods sold under LIFO is less than it was under FIFO, so we know that we have to add back some amount. Okay. The difference between these two is going to be 25,000, so we're going to add, 2,500 to this value, which should give us a total amount of 80,500 for net income. Okay. Because our expense was lower, our net income is going to be higher. In 2012, okay, same thing. Our cost of sales is lower, so we're going to have to adjust our net income up a little bit. So 23,500 is going to be increased by a difference of, it looks like, 1,500, which gives us a total of 25,000 for net income. Assuming that we have a tax rate of nothing, we're not making any tax adjustments, now we can focus on the correct answer. Where do we find net income of 80,500 and 25,000? Right there. Okay, another adjustment that we have here for questions 19 and 20, we want to find the depreciation expense and the book value for the equipment at the end of the year, and the depreciation expense for the upcoming year. So, again, just ignore these for right now. We don't need them. We purchased equipment for $60,000 with estimated useful life of 10 years, salvage value of $20,000. The company re-estimated the useful life of the equipment to determine the total estimated life should be 17 years with a salvage value of $5,000. Depreciation has been recorded for 7 years on a straight line basis. Okay, so we need to figure out, first of all, what these expenses are and how much we've used up. So we have equipment that we purchased for $60,000. 10-year useful life, salvage value of $20,000. So we're going to subtract the $20,000 salvage because we'll get that in the future, which means the depreciable amount is going to be $40,000. If we divide that by 10 years, that means that we're depreciating $4,000 per year. Okay, $4,000 depreciation per year. By 2013, we have depreciated this for 7 years. So multiply that by 7 years means that we have depreciation of $28,000. Accumulated depreciation. So the book value is going to be the original cost minus accumulated depreciation. So 60 minus 28 gives us a book value of, that looks like, $32,000. Okay, that was what we were looking for. Book value and the depreciation expense for the year. Let me just highlight those real quick. Book value, depreciation expense for the year. So if we come back here and look at our answers for 19, depreciation expense is going to be $4,000. We can eliminate B and D. So now the book value is what we care about. $18,000 versus... So if we look at the book value is 32, so we know the correct answer is C. Now we're re-estimating this. So the current book value is $32,000. We re-estimate the useful life of the equipment. Total estimated life should now be 17 years with a salvage value of $5,000. So we've recorded 7 years of depreciations. Now we have $32,000, which is our book value, minus our salvage value of $5,000, gives us a total depreciable value of $27,000. Okay, $27,000 from today. We've already depreciated 7 years, so we're going to add 10 more years of life. We estimate that it'll last us 10 more years. So basically we just take that 27,000, divide it by 10 years, and our annual depreciation will now be $2,700. Okay, so if we look at question 20, we want to find the value that matches that, and we see that 2,700 shows up as answer C. For the rest of these problems, I'm going to let you go ahead and work on these. Here in problem 1, you're looking at a multi-step income statement and a classified balance sheet. You can find the multi-step income statement on page 173 of your textbook. So you can go through and look at the classifications. And the classified balance sheet you can find on page 116. There's a good example of each of the classifications. Just the key differences here. Okay, cash is going to be a current assets, accounts receivable, current assets, allowance is a contra, current asset, prepaid rent, current asset, inventory, current asset. Equipment is going to be a long-term or non-current asset. Accumulated depreciation, non-current asset. Accounts payable is a current liability. Notes payable due in 6 months is a current liability. Salaries payable, current liability. Current liability, common stock. Common stock is going to be an equity account. We have a retained earnings equity account. Sales revenue is going to be revenue. Cost of goods sold is an expense. Salaries expense, 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 expense. Okay, these salaries, rent, and depreciation. Okay, these are operating expenses. The interest expense would count as an other expense. Loss on the sale of equipment will be an operating expense. Loss on discontinued, that'll be a separately reported item. So discontinued operation. And loss on write-down of equipment due to obsolescence will be an operating expense. So you can use those to classify different accounts. Statement of cash flows. Statement of cash flows, you can find an example of this on page 205 to 206. Okay, the key thing is to focus on what type of statement of cash flows we're looking for. In this case, we want a direct method for the operating, which means that you want the entire statement of cash flows, not just the operating one. So cash received from customers, we would count that as an operating. Interest on investments, going to be operating. Sale of land. Land is a fixed asset, so you'll expect that to be in investing. Issuance of common stock is financing. Issuance of debt security, financing. Cash paid interest on debt. When we pay interest under US GAAP, it will be classified as operating. Income tax. Income tax will be operating. Debt principal reduction, so we're paying off loans that we have. That typically falls into financing. Purchase of equipment will be investing. Purchase of inventory will be operating. Dividends of common stock, dividends on common stock. If we pay these, then these will be in our financing section. And operating expenses will fit into our operating section. So you want to classify these properly and present them in the proper format. Now, remember that this is the direct method, so direct starts with cash from customers and cash paid for expenses, etc. Okay, so you have a total beginning cash, which you had here. Beginning balance was $5,200. So you want to figure out the change and the ending cash. On this particular problem. Finally, I threw in another example of what one of these judgment cases would be. So judgment typically means that you have to classify these based on your experience. So here we're looking at audit client we want to identify what the appropriate reporting treatment would be and whether it would be in continuing operations, separately reported, or an adjustment to retained earnings. So depreciation expenses were omitted from the income statement. That means we have to make an adjustment. And that's going to go to retained earnings. Useful life of all machinery was changed from 8 to 5 years. This is a change in accounting estimate, so there's no, well, it's a change in estimate. Okay, and that just means it's going to affect depreciation, which would show up in our continuing operations. $10 million face value was paid off. It considers the event unusual and infrequent. Okay, so this is an extraordinary event. An extraordinary is separately reported from the continuing operations. Inventory costing method was changed from FIFO to average cost. Okay, so this is an adjustment or a change in accounting. It's going to be a change in accounting principle, which means we have to retrospectively adjust it. So that's going to have an effect on retained earnings. And restructuring costs were incurred. This is typically just a regular operating expense. So it will show up in our continuing operations. Okay, so you want to focus on the types of accounts that you would see here. Hopefully this exam review has been helpful. Take a look at it. If you have questions, feel free to draw me a line. Otherwise, good luck on the exam. Expect the questions to be a little bit more involved than these, but you kind of have an idea of where you're going. So, good luck on the exam.